Intense volatility has been witnessed in the precious metal counter, with gold prices hitting the low of 1339 during the week and then rebounding to 1410, 1414 levels, and now again retracing back to 1370, 1380 levels. Markets has been confounded as far as the remarks from Ben Bernanke in respect Ben Bernanke's remark on the quantitative easing program. There have been mixed signals where the chairman of the Federal Reserve has stated that it would be too early to scale down the quantitative easing program, as a premature scale down would lead to derail of the economic recovery. But the policy minutes state that the apex body is ready to taper down the bond buying program, provided that the housing markets and the employment markets continue to show signs of strong growth. At the current juncture, the prices have actually stabilized, as a deterioration in the global equities, categorically Japanese stock markets, have provided some support to the gold prices, where some kind of buying or investors have been flocking to the yellow metal. However, as far as the short-term outlook is concerned, we suspect that gold prices would not extend the uptrend, and prices would face resistance around 1410, 1415 levels. We infer that the US equity markets still remain resilient, and the macroeconomic landscape in the world's largest economy is continuing to show signs of strong improvement. The recent sell-off in the global equities seem to be a short-lived affair, where we believe that the money would start again flowing into the US stock markets. As far as the quantitative easing program is concerned, the central bank seems to be reluctant or indecisive as far as scaling down of the bond buying program is concerned. However, the markets are factoring in the fact that the scale down of the quantitative easing program is inevitable. The timing cannot be judged as far as the central bank comments are concerned, but the fact that prices cannot breach the 1450 or 1480 levels on a broader chart basis, we believe that prices would eventually scale down during this week. As far as the base metals are concerned, the pessimism in Europe and China continue to take a toll on the base metals. We have seen base metals oscillating between a sharp upside and then again prices retracing lower. The recent flow of numbers from China particularly have not been supportive, where the latest PMI manufacturing index has shown signs of contraction. So we believe that regardless of the supply side issues in copper, where we have supply disruptions at mines in Indonesia and in US, prices would still remain under pressure, that as the economic activity in the world's largest metal consuming nation, that is China, would continue to restrict any substantial upside in prices, and prices would eventually drift lower. So we believe that copper price would remain under pressure during this week, and we again expect prices to retest the recent lows of 400, 402 on the MCX. On the energy price outlook, prices have actually been seesawing between the price range of $92 on the lower side and $97, $98 on the higher side. We believe that the energy prices cannot sustain at higher levels, as a gloomy backdrop in China and Europe would again restrict any substantial upside. On the fundamental front, expanding global oil supply, huge oil stockpiles in US continue to enact as a headwind for the prices. Regardless of the geopolitical tensions, prices have actually not been able to sustain around the higher levels, that is 97, 98, which is also a strong resistance. So we eventually believe that prices will not sustain around the higher levels, and again there will be a retest of 92, 90 levels in the coming weeks.